So this just happened. Housing supply is rising, demand is falling, and prices are still climbing. In October, listings hit the highest level in 5 years, about 2.1 million homes on the market. That's up 10% from last year. But the sales, down almost 3%. And then the median home price, still around $440,000, up about 1.5%. So basically, it's a buyer's market in theory, but not in practice. And here are the key takeaways that you're going to want to remember. First, more homes are sitting for sale, but fewer buyers are stepping up. Payments are still at record highs. Next, millions of owners are stuck with 3 or 4% mortgages. They won't trade them in. Also, the homes that do hit the market usually come from must-sell cases like divorce, death, or job moves, and new construction. And finally, builders are pulling back. Housing starts dropped more than 8% in August. So future supply, it's shrinking, not growing. And to make this simple, it's like school lockers. Remember those? Some kids, they grabbed the best lockers years ago. Some of them got to school early and grabbed the best lockers. They won't trade, because moving means carrying their books twice as far. So even though lots of lockers looked unused, the few that are open come with higher costs. And here's what this releases. It means you can start looking for homes with assumable loans, where you take over the seller's old rate. It means you can push builders harder for deals, price cuts, free upgrades, or cash to lower your rate. It means if you've got cash or strong terms, you face less competition and more leverage. And if you're an owner who needs to move, renting out your old place keeps that cheap loan alive while you figure out the next step. And here's why it matters. The winners right now are homeowners with ultra-low mortgages and investors who can buy in cash. The losers are first-time buyers and families who need to move. Housing normally fuels the economy, but with sales at 30-year lows, movers, remodelers, and realtors are all feeling the pinch. And inequality is widening because the only people who can move freely are those with cash. And when it comes to the quiet part no one is saying out loud, policymakers would rather keep prices high than see another housing crash. The Fed knows that lower rates could backfire because demand jumps, but sellers stay locked in. And then local rules still make new building slow. And that means this freeze doesn't clear anytime soon. But here's what the experts are saying. NAR's chief economist says prices could even slip a little, maybe a single-digit drop. Redfin's team calls it a buyer's market on paper only, and they expect a mild price dip as sellers adjust. And then others warn that the builder pullback is a warning for the whole economy, not just housing. And to push back, a few independent voices still call for a sharper correction if job losses rise. But here's what most people are missing. This lock-in effect is both a demand killer and a supply killer. So when rates finally do drop, demand floods back faster than supply. And that means bidding wars can return overnight. And as always, there are two sides to this story. One side says prices will not crash because there just isn't enough supply. The other side says affordability is the worst in decades. So something's got to give. And here's what the smartest person in the room is thinking. Those 3% mortgages are golden bonds tied to houses. The play is to hold scarce shelter now and refinance when the thaw comes. But here's what everyone wants to know right now. Should you buy or wait? Well, if the payment works for you and you can stay for at least 5 years, buy with concessions. If not, wait. Will prices finally fall? Maybe a little, but not a crash unless the jobs crack. Well, what happens if rates drop to 5%? Well, buyers, they rush back and prices likely push higher again. Yet, here's what we really need to know before we know what comes next. Do mortgage rates fall far enough and stay down long enough? Do listings keep building, or do sellers pull back again? Do price cuts spread, or do homes just sit longer? And does the job market weaken, or does it hold? And ultimately, we want to know, has this ever happened before? The answer is yes. In the early 1980s, rates were sky high, sales collapsed, but prices mostly flattened instead of crashing. Creative financing, assumable loans, seller financing, that kept deals moving. And the buyers who managed to hold on came out ahead once rates dropped. So the lesson is, this is more likely a grind than a cliff. Quick translation, for W-2 professionals, treat this like a project plan. Focus on the monthly payment first, location second, and timing last. So what would that be for today's move? Look for a seller's loan that you can assume, or a builder willing to buy down your payment. check out Rome.com or AssumeList.com. That's what they do over there. You can take over people's mortgages and only buy what you can hold for 5 to 7 years. So for more videos, community support, and the Deeper Dive newsletter, links are down below in the description. And in case you missed the last one, this here will get you caught up. Thanks for watching. Have a blessed day. Take care.